So as I said, you beat on earnings per share, you beat on revenue, and as I understand, you were profitable across the board. Give us the highlights from your point of view.
Yeah, I guess as I look at it, David, the headline from our perspective would be Q1 results solid, very, very much on plan and consistent with the guidance that we provided for the year for another year of strong earnings and cash generation at General Motors. $2.6 billion of profit, 7.2% margins. Within that, importantly, very solid performance in North America, especially given the planned downtime that we had in full-size pickups, with $2.2 billion of profit and 8% margins. Record profitability in China in GM Financial, $600 million of equity income in China, almost $450 million of earnings at GMF, and another quarter of improved results in South America. So as I said, very, very much on plan and consistent with our guidance for the year for another strong year.
Record profits in China. That's been a big player for General Motors. At the same time, China's in the news just about every day. And just this morning when I woke up, it said that China is now considering cutting their tariffs on imported automobiles. Will that affect General Motors? If they go through with that, will that affect your business at all?
I think the impact will be pretty minimal, David. We build where we sell, and the vast majority of the products that we sell in China are built there. Obviously, we have a very, very strong position with 14.8% share, very strong brands, both locally and with the foreign brands, Buick, Chevrolet, and Cadillac. So, you know, we believe that the tariff impact in China is going to be, whether they reduce it or not, pretty minimal to our business.
One of the things that I did notice was in free cash flow for the quarter, you were actually negative. You were negative something like $3.5 billion. What was that about?
Well, typically, David, we burn free cash flow in Q1, and it's just seasonal factors when you think about working capital. In a typical quarter, it'll be about $1.5 billion if you look at history. In the first quarter of 2018, as we expected and as we guided, we expected free cash flow to deteriorate versus typical run rate. That was largely driven by the truck downtime that I talked about before that impacted North American earnings. It was driven by working capital, again, the truck downtime and timing of production, and it was driven by incremental capital spending in the first quarter versus typical run rate in support of our launch of the full-size pickups. We expect that to completely reverse as we go into Q2, Q3, and Q4, and continue to expect to generate, carryover free cash flow generally in line with 2017, which will be about $5 billion.
So it sounds like a timing issue largely. Something that isn't necessarily
For sure.
timing is
as expected.
Is expected, exactly, as guided, as you said. But what about commodities? That's not necessarily a timing issue. Are you feeling margin pressure, as some of your competitors are, on the increased cost of commodities?
Well, certainly commodity cost increases and the pressure now versus the beginning of the year are greater. When we look at what's developed around the world, both from a steel and aluminum perspective as well as just general commodity increases. With that said, if you look at our first quarter numbers, we were able to offset commodity headwinds. I'd say broadly speaking, it was about a $200 million headwind. We offset it with improved commercial material performance technical savings. And our plan for the year and our expectations for the year is that our material performance will mitigate commodity headwinds, and that's what we're executing to. Hence, we haven't really changed our view on the year from a guidance perspective. We're very, very focused on offsetting those headwinds.
Last time we talked, South Korea was an issue for you. It was looking like you might even have to walk away from it. Is that all resolved now? I saw that there's a deal with the labor unions.
I'm glad you asked that question, David. I would say that we're on the verge of a landmark historic agreement in Korea. Thursday, Korea time, the union ratified a very, very important labor agreement. Taken with the labor agreement and the efficiency in that labor agreement, as well as the previously announced plant closure, we will generate between $400 to $500 million a year of savings on a go-forward basis, which will put us in a profitable position in Korea in 2019. In addition, we've got a preliminary agreement with the Korea Development Bank to co-fund $750 million of future capital investment to build the foundation for future success in Korea. And this is an example, a demonstration of shared sacrifice across all shareholders, ourselves, our union partners, the Korean government, and the Korean Development Bank, and the outcome is going to be a viable, sustainable, profitable business, and we're very, very pleased with that result.